Applied Materials, like the entire semiconductor equipment sector, sits at the heart of the AI revolution, powering the chips and technologies driving this explosive growth. But is this optimism justified? And is the stock worth its current valuation? In this video, we'll dive into the valuation of Applied Materials. We'll compare its key price ratios against both competitors and its own historical averages, review what Wall Street analysts are predicting, and run a detailed DCF calculation to estimate what this stock is truly worth today in the worst case, normal case, and best case scenario. We'll kick off the valuation by looking at price multiples. These are the ratios that divide a company's share price by a financial metric like earnings. For the average stock, a PS ratio between 1.5 and 2, a PE between 15 and 25, and a PB between 2 and 3 are typical benchmarks. Here we see Applied Materials price ratios over the past 5 years. The PE ratio is currently at around 24, slightly above its median of around 20. The PS ratio is 5.8 compared to the median of 4.9, and the PB ratio is 8.4, around its historical averages of 8.3. But both are way higher than the broad market norm. In the semiconductor industry though, higher PS and PB multiples are standard due to strong margins and capital-intensive operations. So while Applied trades above its historical averages, its valuation is fairly typical compared to peers. Looking at PE ratios across competitors, Applied Materials stands at 24, which is lower than both Lam Research at 28 and KLA at 33, and only slightly above Tokyo Electron at 23. What's interesting is that Applied has consistently been valued below its competitors since at least 2021. This gap is likely due to its slightly lower growth profile compared to the high flyers in the industry, which investors tend to reward with higher multiples. Here's a summary of Applied Materials price ratios. The PE ratio is at 23, which is about 16.5% higher than its historical average, but it's still 12% below the industry average of 26. The PS ratio is 5.5, standing 9% above its historical norm and almost 11% higher than the industry's 5. Meanwhile, the PB ratio is at 8, which is 7% below its own average, yet 17% above the industry benchmark of 7. Looking beyond these multiples, we have a cash flow yield of about 3.75, which is decent but not high. And then we have a PEG ratio of about 3.2. This is based on my own DCF model, suggesting that growth expectations are already priced in. Considering all this, I've rated the price ratios as average, maybe leaning slightly expensive. Morningstar is a well-known research firm that provides independent stock ratings and fair value estimates. According to them, AMAT's fair value is $193, which means that the stock is trading close to what they consider its true worth. They have also assigned a wide economic moat, indicating durable competitive advantages. For comparison, Lam Research and KLA are both trading above their fair values, while Tokyo Electron is closer to its target value. I've gone into more details about AMAT's moat in a previous video if you'd like to explore that further. Here we see Morningstar's valuation of Applied Materials over time. The stock is quite cyclical and has moved between periods of overvaluation and undervaluation, but right now, it's very close to Morningstar's fair value. Notice the stars below. Morningstar's rating has been steady at 3 to 4 stars over the years, reflecting a solid company with strong financials. I've also shared my own business assessment in earlier videos. Guru Focus provides a slightly different perspective on Applied's valuation. On the left, we see that the stock price has closely followed its price-to-book ratio with a 83% correlation, and this model projects potential growth pushing the price towards $240 in the coming years. However, this approach is based on just one metric. On the right, their broader valuation model, which combines a discounted cash flow analysis with price ratios like PB, places Applied's fair value closer to $158. This is a more conservative estimate compared to Morningstar's view. Finally, TipRanks compiles Wall Street analyst targets, with an average 12-month price target of about $203, a high of $250, and a low of $160. Compared to Morningstar and Guru Focus, this sits somewhere in the middle, neither overly bullish nor bearish. The current share price is around $188, while Analyst average price target sits slightly higher at $197. On the surface, this suggests the stock is fairly valued. But are Wall Street analysts correct? Let's calculate our own fair value using a discounted cash flow analysis. Before diving into valuation, let's do a quick technical analysis. This chart shows a clear ascending support line that stretches all the way back to 2016, with several plateaus where the stock has consolidated over the years. Right now, the price is hovering around $188, positioned between a strong support level near 153 and resistance at all-time high around 259. In my view, as long as this long-term trend line from 2016 remains intact, this area could be considered a solid entry point, backed by both the rising support line and the consolidation zone from 2021 to 2024. Okay, time to do my own valuation. This slide shows the 5 steps I use for my DCF analysis. Feel free to pause if you want to look closer. In short, I project future cash flows by using revenue growth and free cash flow margin. Add a multiplier to this free cash flow, then apply a discount for the time value of money and subtracting debt to find the fair value. So let's look at their current free cash flow. Applied Materials generated $5.86 billion in free cash flow over the last 12 months. Most of this came from net income of $6.76 billion, offset by capital expenditures of $1.6 billion and changes in working capital. Stock-based compensation is minimal, which is a good sign. Free cash flow has grown at around 11 to 12% CAGR over these 5 years. Let's walk through the DCF setup. Over the past few years, revenue has grown at around 10% CAGR, while free cash flow has increased even faster at 11.6%. But notice the revenue slowdown in growth. This is something we need to take into account with our projections. The average free cash flow margin is 22.5%, and the historical price per free cash flow ratio has hovered around 22%. These figures gives a solid foundation for building realistic projections. For the normal case, which I assign a 50% probability, I'm assuming 7% revenue growth over the next 5 years and 8% for the following 5. Free cash flow margins improve from 19% to 21%, slightly below the historical average, and this is to keep assumptions conservative. I use 19 times terminal multiple, a touch lower than the historical average. In the worst case, which I have at 25% probability, revenue growth slows to 6 to 7%, margins drop to 16 to 17%, and the terminal multiple is reduced to 17. On the other hand, the best case scenario assumes stronger growth of 8 to 10%, expanding margins up to 23% and a 23 times multiple. I'm using a 10% discount rate, which is my standard for most companies. These are the raw numbers from my DCF across all 3 scenarios. You can pause to review this, but I prefer to see the results visually, which I will explore next. Here we see the worst case scenario for the DCF model. The assumptions at the top show revenue growth of 6.5%, free cash flow margins at 17%, and a terminal multiple of 17 times. Revenue starts at $29.7 billion in year 1 and grows to around $52.7 billion by year 10. Free cash flow increases more slowly, from $5 billion in year 1 to about $8.5 billion by the end of this projection, reflecting the tighter margins. The fair value for Applied Materials in this scenario is just $115, with a margin of safety of minus 40% and an IRR of 3.2% per year, which is far below my minimum threshold of 12.5% per year. Comparing historical to projected values, you can see how much more conservative this scenario is, and it highlights the downside risk if growth slows. The normal case scenario, which I consider the most likely outcome with a 50% probability, uses more realistic and balanced assumptions. Revenue growth of 7.5%, free cash flow margins increasing from 19 to 21%, and a terminal multiple of 19 times. Here, revenue grows from $30 billion in year 1 to about $58 billion in year 10, while free cash flow climbs to $12 billion. The fair value here is $169 per share, with a margin of safety of minus 11% and an IRR of 7.8%. This is still below my preferred thresholds, but it's far better than the worst case. Comparing this chart to the dark red dotted lines of the worst case, you can see the improved growth trajectory and stronger free cash flow margins. In the best case scenario, with 25% probability, I have assumed a revenue growth of 9% for the next 5 years, increasing to 10%, with free cash flow margins expanding to 22% and a terminal multiple of 23 times. With these inputs, revenue accelerates from 30 billion in year 1 to 66.5 billion by year 10, and free cash flow rises sharply to 15 billion. The fair value estimate in this scenario is $235 per share, with a 23% margin of safety and an IRR of 11.7 per year. This is closer to my investment target. Comparing this chart to both the orange dotted lines of the normal case and the dark red lines of the worst case, the best case scenario reflects a much stronger growth and profitability outlook. Here's the summary. Based on my probability-weighted DCF, the fair value comes out to $172, about 10% below the current price. The expected return over 10 years is around 7.7% annually, or a 109% total return in 10 years if we held it the entire period. Price ratios are mixed, indicating Applied is fairly valued. The cash flow yield of 3.8% is decent, but not exceptional, and the PEG ratio of 3.18 shows that growth is already kind of priced in. Overall, while Applied Materials is a strong business, the current valuation looks closer to fair than cheap. If you want to go deeper into Applied Materials, make sure to check out my other videos. In part 1, we look at the business model, analyst and management commentary, and what insiders are doing. Then in part 2, we look through their financials and also make a thorough moat analysis. Hit subscribe so you don't miss either one.